Hello, everybody. For those of you who don't know me, I am John Pace. I'm the owner of the Pace of Richmond Group with Keller Williams Realty. And I thought I might take a little bit of your time to talk about 2021, what the market looked like, and where we are going in 2022 and potentially 2023. For those of you who don't like long videos and prefer more succinct information, go back to the email that we sent this video in, and you'll see some quick bullet points around what happened, where we're going, and you'll get about 80% of what we're talking about today. But for those of you who for a little more deeper dive, get your favorite beverage, sit back, and let's have a conversation around the real estate market and where things are going. Last year, as you all know, was a very strong real estate market. I'll show you some data here shortly, but in succinct numbers, 2021 was almost tied for the third highest number of homes sold. Days on market dropped precipitously, where most homes are selling within a week. Increase in value was for single family homes around 12%, and for condos and townhomes a little over 9%. And so what does that mean? Where is it going? Are we in an inflated market? Is this a healthy market? And so these are things we're going to be talking about today. So let me go into the first slide here. And this is one showing new housing starts going back to 2002. What I wanted to do to start off the conversation was look back of maybe how we got here. What were the precipitating factors that are driving our current economy? And one of the biggest things that is impacting us currently is housing starts or the lack thereof. If you look at how the market was increasing tremendously back in '05 and '06, when the housing starts started falling off, that was one of the bigger indicators that the market was shifting tremendously. And we bottomed in roughly 2009-ish. And you can see we kind of bounced around almost to 2011 on our housing starts. So for those 3-ish years, and you can even include 2007 in that too, so 4 to 5 years, we were really low in the number of homes being built, which is not even keeping close to the demand that the market currently has now. But this lack of homes being built by builders, because there was one, either no funding to be able to build the homes, and two, no one was buying them, that it's caught up with us right now, and we're way behind on the number of homes we need for the amount of people that are looking out there right now. So this is an interesting fact. Number two, I wanted to share with you mortgage rates. We all know when we buy a house, we're really not buying the price, we're buying the monthly payment. And the monthly payment is tremendously impacted by the interest rate. And right before COVID, not right before, but a year or two before, we were still a historic low. For those of you who don't know, our average looking back several decades is around 8%. So anything below 8% is a very good rate historically. Unfortunately, for the past couple of years, 2 years, we've gotten used to seeing rates in the twos, and that has become our new normal. And as of last week, we have jumped up into the mid threes. We're forecasting somewhere this year we'll hit the fours, and after last week's quick jump, we might get to the fours sooner than we thought. Once again, still a very good historic rate. However, people have short memories and they really would love to see a 3% rate happen again. But those really low rates, along with the low inventory, were fueling demand. People were looking for homes. Quarantine got people thinking differently about where they could live, where they could work. And even second homes went through the roof on sales this year, or last year, I should say. Second homes, investment property, all those things, because the rates were so low, people could choose where they could live. They were looking everywhere, and we'll talk more about what that looks like here in a little bit. So this is a slide that Keller Williams put together back in August, and yes, it's a little dated because it actually only went through August, but I like the way the graph looks. I thought it'd be easy to read and share with you guys. So we actually ended up last year just a hair below, actually right around 6.4 million homes sold nationally. So that was just below our third highest year of sales, which were back in the '04, '05, and '06 range. So some people may say, well, hey, we have that many homes sold, and it's very similar to what we had back in '05, '06, and '07. that must be an indicator that we are at the top and we're going to have a market crash here. I don't agree with that for a number of factors, and we'll talk about that right here pretty soon. But once again, it was a really strong year in sales, a lot of homes being sold, even though it didn't really feel like that at all. So let's also look at the trend line. Now, this trend line here looks back to 91, and historically, homes appreciate on average about 4%, plus or minus. You could say 3 to 5 on average. When the market tanked in 08, the value of homes dropped well below that trend line here. And that's because we went well above the trend line from 03 to 07. And then 08 came back to the trend line, and then from 09 on, we've been well below it. This year, or actually last year in 2021, we finally caught back up to that trend line. So when people are asking me, John, is the market inflated? It may feel like it, but if you look at historical numbers, I think we're actually right back where we're supposed to be. Now, the question is, if the next few years continue with the same double-digit sales increase in the actual sales price, then we might be getting ourselves into trouble. We're currently where we are right now. I feel like we're actually right where the market is supposed to be. This graph here talks about, well, actually, the next few graphs are going to talk about the Richmond market and where things were last year and why it felt the way it did. So we have a term called months supply of home, which basically means that nothing else came on the market as of today. How long would it take for us to sell all the current homes that we have in inventory? A balanced market is usually somewhere between 5 and 7 months. You could say 6 on average, between the demand for buyers and the demand for sellers. Well, we are currently at a less than 1 month inventory. In other words, if nothing came on the market as of today, and we kept the inventory we had up to today, it would all be gone in a few weeks, less than a month. And that's why when you look at the number of homes that sold last year, around 6.4 million, it didn't feel like 6.4 million because all the homes were going so quickly. In fact, if you look at I think the next slide is our days on market. Our average days on market, or median days on market, is just below a week. So a home goes on the market within 5 to 6 days, it is off the market. So the speed of this market is making things feel like we don't have anything for sale because there's so much demand. And one of those things about Richmond that's in demand right now is we get a lot of people moving here from DC, from New York, from the whole Eastern Seaboard. We're seeing people coming from the Midwest, from California. Our influx of buyers has increased about 250%. And keep in mind, those buyers are usually coming from markets where the average sales price is double, if not triple, where we are. So those buyers show up with a different mindset or experience on what the value of a house may be. And they'll bring for example, their Northern Virginia sales price, which is around $680,000 to $700,000 for the average. They come to Richmond, they see $300,000 and think it's a deal, and they have no problem bidding a home up to get the price they want. So those factors, along with a low interest rate, are really fueling this speed we have in the market right now. This is the median sales price looking back to 2016, and you can see we've gone way up from the 220 range to now we're at I got my notes here. Give me a second, guys. 336. We went up 12% for single family homes last year at 336 is where we ended up. So once again, is this going to be the ceiling of the market, or are we going to continue to grow? That's a great question. More data here showing the increase we just talked about. So 12%, just below 12% for single family homes, 8% for condos and townhomes. And then a graph showing the number of closed sales looking back from 2016 to 2021. Once again, a lot of homes in Richmond sold. It just didn't feel like it because they went so quickly. So I wanted to run into a couple of scenarios with you guys. So I think it's pretty self-explanatory that the market we're in is very advantageous for sellers. But should buyers wait it out? Are we going to be at the top of a market? And all the indicators we're seeing are showing that we're not going to be having any inventory showing up in the near future. I think we're going to have an inventory issue for at least 2 years, if not 3 to 4. Now, rates are definitely going up. which could slow the market down a little bit. But the problem with that is if the supply and demand issue is out there, not enough supply, a lot of demand, we expect pricing to go up. In fact, we're seeing numbers somewhere between 8 and 10% this year of appreciation. So if a client decided to wait out a year and we still have appreciating values, maybe double digits again, and we see interest rates going up potentially a full point, does it really make sense to wait? So one of our favorite lenders put together a couple scenarios. I'm going to share a couple slides with you. I think it might make it easier for you. This is a home that we sold January of last year for $255. And they had a 2.875% interest rate. So their principal and interest was $1,000 and $1,005 a month. If you factor in the taxes and insurance, it was just under $1,500. But let's just talk about the principal and interest only. So about $1,000 a month at $255 purchase price for a loan interest rate of 2.875. For this year, we're expecting to be closer to 3.875 here really soon. And estimates from Zillow, we haven't put the house back on the market, so we're having to use some guesstimate numbers here, around 290, which is, if you look at the monthly payment, increases from that $1,000, $1,005 to $1,298, almost a $300 per month payment increase, just because someone chose to wait. And if we look at where we think we're going to be going for 2023, let's say we do appreciate 10% more, that could bring us up to around 320 for this house. Rates will probably be closer to 5% sometime next year. And that monthly payment for principal and interest goes to $1,630. So a jump of over $600 every single month, or over $7,000 a year. Or someone stays in the home for 10 years, they're looking at $70,000 more money spent because of a higher price and a higher interest rate. So we are strongly encouraging our buyers who really want to find the right house to jump into that right now, because we're not seeing this market slowing down. We're not seeing the inventory lowering or improving, I should say. And we're not seeing rates going back down to a lower number. They're going to be climbing up over time. So at the end of the day, you really want to be considering jumping into this market if you are looking to buy. Now, there are some loan options out there. We're starting to see ARMs pop back up. So if you know you're going to be in the home less than 10 years, we're actually seeing rates below 3% for ARMs, and that might be something you want to consider. Definitely talk with your favorite lender about that. And if you don't have one, we can make some introductions. But at the end of the day, I think it makes a lot of sense for those who are thinking of making a change to do it as soon as possible before the market continues to inflate and you're caught a year down the road paying $300 more, or 2 years down the road paying $600 more for the same house per month going forward. So I hope you guys find this interesting and helpful. If you have any questions and want to go more in detail, please reach out to your favorite realtor on our team. Be glad to answer any questions you have. Happy to put you in touch with a lender to have a free consultation just to give you some information. But at the end of the day, this market, I feel, is not going to be changing anytime soon. I think this year is going to be a strong seller-focused market that's going to allow people to, if you have a home to sell, to allow you to get really good top dollar. And if you can get a great rate, allow you to push that into the next house going forward. One thing I will also mention is that there are some changes going on with second homes and investment property purchases. Those purchases are through the roof. And if you have thoughts about doing a second home, let us know ASAP. The guidelines around lending are changing tremendously. And I think you guys can do really well, but if you wait too long, those could change as well. So call your favorite realtor on our team. We're happy to answer any questions you have. And I hope you guys have a great start to 2022. Thanks.